Well, with tax time right around the corner, I'm super excited to talk to this guy, the host of the Money You Should Ask podcast, and also the CFO of the Comedy Store, Mr. Bob Wheeler's here. How are you, man?
Joe, I'm doing great. Good to see you. It's tax
It's
time.
good. It's good to see you. You're one of the few people I know who get excited about this time of year. Like this
I,
is a big
I,
giant party for you.
it's fun. We all get to get refunds or pay the government or do something, and we get to look at our past and then file it and move on.
Where did this sickness come from, Bob?
I don't know. I like to figure out how to beat the system legally. So I think that's my joy is let's figure out how to keep as much money in our pockets when possible.
Yeah, one of my best friends said he's like, I'm all for people paying their fair share, but the bad news is that for some people, especially if you have a business, maybe we'll get into that. You got some real estate property. Your fair share and my fair share might be different depending on how good our tax help is.
Yeah, absolutely. And I think a lot of people pay more than their fair share, and there's no need to.
Well, let's dive into this. Just some easy things, Bob. Somebody has a straightforward W-2, the rules changed a while ago. We just work for somebody else. We get W-2 income. We really don't have much else. I know that itemizing has become a lot more difficult. Is there much that the average person listening to this can do if they don't have anything out of the ordinary income wise?
Well, there's still a couple of things you can do. You could contribute to a traditional IRA potentially.
Oh, yeah.
You could still do a Roth IRA. Won't help you now, but it'll save you taxes later. You might qualify for an HSA, a health savings account. So again, that's going to be an adjustment on the federal to your taxable income. So there are still some things you can do. You just don't have as many options.
Yeah, but those are still good ones because it's also putting money away for the future.
Absolutely. HSA is a great way to go. If you're pretty healthy, you just keep socking that money away every year, and you end up not using it. Eventually, it just basically converts to an IRA when you get old enough.
Yeah. Now the HSA, if possible, my understanding is that we probably want to try to pay out of pocket as much as we can and let that money accumulate, let it grow if we possibly can. Do you subscribe to that?
Yeah, absolutely. The thing is, if I'm going to try and take the itemized deductions, probably not going to get anything. But if I can, if I take the out of pocket and put it through the HSA when it's real, I mean, I'm certainly going to get a tax savings. But as much as I can preserve that, I want to try and preserve it and roll it forward and grow it into a nice big fat nest egg.
I know there used to be some help for teachers, for educators out there, for people that are in different professions where they don't get paid, they don't get reimbursed. Are any of those things still alive, even if we don't itemize?
The educational, the 250 has still been around, but slowly dying. There's not that much stuff. You could still potentially get an education credit if you're going to school. Postgraduate or something like that, you might be able to get a tuition credit. It's still available for some people if your income's low enough. They've shaved a lot of that stuff away with this, 2018 tax change.
Yeah, I was going to ask about that, about the Savers credit. I know that got modified, but I'm not sure how.
Yeah, I mean, that one, I'd have to look at that one. I have to be honest. I don't have that many people saving. So yeah. I don't deal with that credit as much. It sort of sometimes pops up and I go,
that one's
that's
also
right.
very, that's for our low income listeners as well.
It is. And nothing wrong with being low income. It's just, I don't deal with a lot of those at the moment. Most of my folks are in brackets that we just don't address those questions often.
Well, and I think a lot of that too is because of the fact that the itemized deduction for most people has gone bye-bye. So I can imagine you wouldn't be working with a lot of those people. Let's say that I want to make sure we take care of our W-2 people first, because that is the majority of our audience. Let's say that I get a number, Bob, and it's a number that is a number I can't pay.
Right.
What do I do then? How do I avoid penalties? What does the penalty look like? How do I get around that?
So you're going to get hit with some penalty and interest. But the most important thing is to still file the tax return. File it on time. So if you can't file in April, file that extension so that at least it's still timely. Because if you don't file on time, you're going to get hit with a 20% filing penalty for not filing
Failure to
on time.
file.
Failure to file, 20%. It's huge, 20% of the liability. So you don't want that. You can work out a payment plan, file the return, pay what you can. If you can't pay anything, wait for the notice because they're not going to work out anything with you until they have your tax return in the system. And then you're going to want to call up and talk to them about a payment plan, which can be spread out over up to 6 years. Now you're going to pay a 5% penalty, and the interest rate right now is still about 5%. It might have just gone to 6, but it's still relatively cheaper than a credit card. And
say not egregious.
It's not. It's not. So work it out. Make a payment plan. IRS is very accommodating when it comes to making payment plans. They just want to work something out. Talk to them.
I talked openly about my issues back in the mid '90s when I was horrible with money, Bob. And one of those things was I owned a small business. I did not know anything about taxes. I didn't know about hiring people who would help me and teach me. Instead, I just gave my stuff to a tax preparer, came back and said I owed a bunch of money, which, by the way, now that I know how it works, I probably didn't because I didn't get him the right stuff, right?
Right.
I did not understand what was deductible as a business owner. However, the big point I wanted to make was that at that time, calling the IRS, when I finally got my act together and calling the IRS and working out that payment plan, I thought it was going to be horrible. It was incredible. These people were very helpful. They were so accommodating. They worked with me. It was, had I known that this devil in my head wasn't nearly as bad as it was when I called, I would have called way sooner. Is IRS still the same? Still very helpful people?
Look, about 90% of them are super helpful. You get a few that are like power trippers, but that's anywhere.
Well, I was going to say that's IRS, any business, right? Yeah.
That's any business. But the IRS, unlike California, is very accommodating. They want to work things out. They want you to communicate. So even if you can't pay now, they'll delay. They will work with you. Talk to them. Most of them, they're all taxpayers too. They want to help you.
Let's talk about some of the things that are small business owners. If you've got a side hustle, right? A lot of our people trying to make a little income on the side. What are some of the things you see side hustlers generally miss because they're not true full-fledged business owners? So it goes right over their head that this might be deductible.
Yeah. So a couple things. I see people missing cell phone, internet, home office. A lot of people miss home office. And if you're using a small portion of the house that's dedicated for an office, that's a deduction. Take it. Especially if you're a renter, you're going to get that extra bump on reducing self-employment tax. The other thing that I see people miss is, oh, well, I bought some supplies or I bought a computer, but I use it for this and that. Or they don't pick up the mileage, run into the store to get supplies, running out to have a consulting meeting. Those little things, even if it's $100 here and $200 there, it adds up.
Do you have any tracking software or an app that you especially like to kind of track that as you go?
Well, I love and hate QuickBooks. It's a great little program. QuickBooks, Quicken. A lot of my clients use Mint. It's not 100% because if you don't attach all the accounts, you don't get all the information. But I have a lot of people in entertainment, and so what I also have them do is I tell them get 10 big yellow envelopes and divide them by supplies, automobile, cell phone, and just throw all the receipts in the envelopes and just give me the envelopes and I'll just take it from there. Because
I love that though, Bob. It's less about the cool tech than what you're going to use. What you're telling me, I think, is whatever you're going to use is what's the best thing.
Yeah, absolutely. Just do something. And I'd rather, and like I said, I have a lot of entertainment people that zone out when I say the word tax. So fine, just put it make it organized enough so that I can figure it out. I don't want to unfold your receipts from a grocery bag.
What if I go to a business lunch, business dinner? I think those changed a few years ago. Can I still write those off?
Well, you still can. And actually this year is the last year that if you go to a restaurant for business, you can write off 100%. starting 2023, it'll go back to 50%, which is what it was historically.
I needed to know this in December, dude. I needed to have like a big, huge quote business dinner. You and I should have had done that at FinCon.
We did. I think we did. I think you spent a couple $1,000. I just remember.
Oh yeah, that's right. I totally forgot. Thank you.
Yeah.
Committing fraud here on the Stacking Benjamin show.
Yeah, absolutely. You got to catch us. No, I mean, that's the thing. I mean, I've had people come in and say, I have like 32,000 worth of meals and I earned $5,000. Probably going to get a second look at that from the IRS. You want to be reasonable.
Yeah. And let's talk about our real estate investors out there, because we have some brand new budding real estate investors. We have a brand new real estate sister show, Stacking Deeds. What's something you see our real estate investors commonly miss?
So one of the first things that I see is new investors don't understand that if they're over 100,000, the losses start to phase out. And at 150, they're gone. So a lot of times clients will come in, they've spent 20, 30,000. They know they've got a loss and they're like, yeah, I'm going to get a big deduction. And they get a big fat zero deduction because they're slightly over the parameters that allows them to take that deduction. So that's a huge shock to a lot of people when they're counting on that $20,000 or $25,000 deduction. The other thing, if you're doing it yourself or you're moving to another accountant, a lot of people forget to pick up those passive losses for those people that were over the 100,000. Oh. And I've had people come in and say, everybody told me I was going to get a refund, but I owe $20,000. And I look at the return, I'm like, oh, you forgot to release the 150,000 of passive loss carry forward. And, making a couple adjustments, now they're in a refund mode.
Wow. It's like releasing the tax refund Kraken, right?
Exactly. Bring them out. The other thing I would say about real estate, especially with the primary residence, but with anything, because I see this happen a lot. If you sold a house and it's your primary residence and you're under the exemption of 250 or 500,000, you still have to report it on your tax return. It's not a taxable event, but it's a reportable event. And I've had so many clients with housing and with stocks and bonds. Well, I lost money, so I don't need to report it. Yes, you do. You will get a big fat notice.
Wow. Yeah, yeah. And that letter from the IRS might make your heart beat a little more quickly.
Yeah, absolutely. And I have sophisticated taxpayers that said, well, yeah, I didn't report the house because, I didn't make a profit. Yeah. You need to.
No.
Oops.
Still have to. This. A lot of our stackers don't know this. They think this is the time of year for tax planning. This is the time, the conversation you and I have just had is about really putting Humpty Dumpty together, after he fell off the wall, which was December 31st of last year. Truly, if we're going to make tax moves for 2023, the time to do those is before December. What are a couple things our stackers could be doing today for next year's taxes? Won't help them with this April, Bob, but we'll maybe start to make a dent for next year.
Yeah, absolutely. And you're absolutely right. We start all of our tax planning in October and have everybody knowing where they're going to land by the time we get to March or April, because December 31st, last day, January 1st, too late for most of it. So a few things. RMDs, if you've got to take out money out of a retirement account and you don't want to claim the income, but you've got to take it and you're charitable, give the money to charity. You count as an RMD and you don't have to include it in your taxable income, right? And that's a much better way than claiming the income and making a donation. Better to just not have it in your income. So RMDs, you can give to charity. A couple of other things. It might be time to convert some of that traditional IRA or SEP into a Roth IRA. If this is the year you're not going to have a lot of income or you're going to have negative taxable income, convert some of that to a Roth tax-free or at a very low tax rate. And now you've got a Roth that's going to grow tax-free continually. So that's another big one that I would say to do. If you're having a lot of capital gains, you might want to talk with your financial advisor and generate some losses on stocks that are never going to make a comeback, and what they call harvesting. And you'll want to harvest those losses to offset. So that's something to play with.
I always see people that should be tax loss harvesting don't do it. And I see people that are, 25 years old with a $18 capital gain, or that they want to cover up that they're tax loss harvesting. And I'm like, don't worry about this when you're in your 20s. When your portfolio gets much bigger, do it. This is not a reason why, by the way, to use a robo advisor, to manage your money, because they say they'll do tax loss harvesting. If you're just starting to save, probably not for you.
Well, the other thing I would say too is I have a lot of clients come in and go, man, I lost $100,000. We get to write it off. That's not something to be excited about. You lost $100,000, right? It's great that we're going to get a benefit, but you still lost. Don't be excited.
There's a, I remember there was a guy in the radio and TV. There was a guy in the radio in Detroit, excuse me. I'm going to do that again. There was a guy in the radio in Detroit, a guy named Rick Bloom, who used to always say, Bob, and I love this line. He's like, don't forget, our goal is to have Bill Gates' tax bill. Like, our goal is to have more money. If we could have more money, like if we can be Jeff Bezos, Warren Buffett, like that is the goal. It's not having a ton of write-offs. Like that is not the goal. If I owe a bunch of money in taxes, I should be high-fiving myself because I had a damn good year.
That's right. And it's funny because now a lot of my clients come in, and when I tell them they owe, they'll say, and I know I'm supposed to be excited because I'm doing well. I said, that is exactly right.
Nice job. Yes. So 2 questions. Number 1, if people have questions for you and they want to get in touch with you, how do they do that?
Yeah, they can reach me at, the best way is bob@themoneynerve.com, bob@themoneynerve.com, because that handles my tax practice, my one-on-one money and emotions coaching, and the podcast and everything. That's the best place, catch all.
Well, and that is the second question, which is, I want to hear what's coming up. There's got to be something secret that you haven't told anybody yet that's coming up on the podcast that you can share with our Stacker community.
Well, let's see. We have coming up in the next 4 weeks, we've got the top fans only personality is going to be coming on our show. It's got 20 million followers. She's going to share her money. Yeah, she's going to share her money mindset with us.
Wait a minute.
Should be a lot of fun.
When you say the top fans, are you saying the top only fans?
Right. She's
earner.
She's the one of the top 5 OnlyFans top earners.
Holy cow.
Yeah.
Yeah.
So that'll be fun. And
money mindset.
And she's going to share her money mindset or some kind of mindset. And we also just had 2 financial fraudsters, one unbeknownst to him that he was committing, federal fraud laws and went to prison. And then we actually, somebody that took about $50 million and was on the most wanted list, shares about his journey.
Holy cow. Those are some stories.
Those are some stories. Pretty crazy.
Man. And that's the Money Shoot Ass podcast, which is available wherever finer podcasts are distributed.
Only the finer podcast.
Thank you so much, Bob, for hanging out with our stackers and helping us do better with our taxes. I really appreciate it, man.
Yeah, absolutely. Well, please feel free to reach out. We love to help people, give them guidance, and, happy tax season.
All right, guys, that's for the podcast. Nice job. High five, Bob. And now if you guys have questions, bring them. So if you're hanging out with us on YouTube, if you're hanging out here with us locally and you'd like to ask a question, feel free to bring your question. Bob, I do have a question for you while we're waiting for people's questions. So this is the worst question ever, by the way. This question is going to make me sound so horrible. However, charities, and we've had people on that run foundations. We've had people on that try to spur people to give more to a 501c3, and so they work with these sponsors who gift them stuff. And then they have these events. Where they give stuff away. Right. So Here's my question. If I have that required minimum distribution that I need to make, and I'm at a charitable fundraiser, and I can bid on the all expense paid trip to, don't shake your head, no.
No, sorry,
Oh, I can't use
no,
my RMD for that and then claim it as a gift to the charity.
no,
One
no,
star.
no.
One star, Mr. Wheeler. One star.
No, sorry about that. Here's the thing, because you're also getting something. Yes, you're helping the charity, but you cannot receive goods or trips or any of those things. That's you actually got something for your money.
Yeah. So whenever you do those, when you're at those charity fundraisers, you cannot write off any of that stuff when you make those gifts.
No, and even if the trip was worth 1,000 and you paid 1,500, that was just from the generosity of your heart. Like,
Sure. Yeah.
you're not getting a deduction.
Yeah. Yeah. I used to,
Yeah.
it's funny. I've had that question 3 times this year from different people. And it's funny because I didn't know the answer. And when you just said that, I've even thought that at charitable events. I'm not old enough quite to take money out of my IRA. I'm certainly not old enough for RMDs, but I did wonder that when you said it. I'm like, I wonder if there might be a no.
Yeah, and even if let's say you buy tickets to a concert, it's for a nonprofit. If the value of the ticket might have been $50 and you paid 200, you might be able to take 150, but not the value for the actual ticket.
Gotcha. So if I can find the fair market price and then whatever I did
Yeah,
over that I didn't receive. Okay. Well, yeah.
that's
So
right.
then the
That's
answer
right.
is the answer is maybe.
The answer is maybe. That's right.
Yeah. Gotcha. Okay. All right. That was my pressing, slimy question about how they. Well, and you know what's funny and it is really it is kind of sad, but to get people to give more, right? You have to do these types of things. If you're
You
and,
do.
and I've worked with 501c3s, and man, when you get these things, people go crazy. Um,
They do.
Karen says from our team, what if you don't win anything at the charitable event? Well, then if you give any money, if there's zero, my understanding then is, well, Bob, I should let you
Yeah.
answer this, but I think you can then donate it, right?
Yeah, that's right. If you ended up giving some money to the auction and you got nothing in return, that's a donation.
But if it was a charitable dinner, you got
Mhm.
dinner, but you got dinner. So then whatever the
Fair market
50
value has
bucks
to
or
come out.
yeah,
Yeah.
gotcha. Okay. All right. So we got that. Guys, we got anything else for Bob? This could be pretty exciting if we don't.
Well, here's something I'll mention that this happens more often than not. Make sure you're filing the correct filing status. Are you single? Are you
Are you
married?
kidding
Filing
me?
separate.
You
I'm not
can't be
kidding
kidding
you.
me.
I'm so filed a tax return for a client for their kid, filed single. IRS came back and said, well, his wife filed married, filing separate. So I go back to the kid. He's like, yeah, don't tell my parents. We're married. Okay.
Oh my
Well,
goodness.
yeah, might have told me that when I filed your tax return because I had no idea. Um,
I could have been in on the secret.
yeah. So
Wow.
I get filing statuses a lot, especially people that are going through a divorce. One person may file as single, the other person may file married, filing separate. The thing is, if you've separated before the end of the year, even if you're not technically divorced, you still may be able to file single. So the statuses are a little bit, it's surprising how many people actually use the wrong status. And I had somebody come to me that had some issues because their accountant, one year they were single, next year they were married, filing separate, next year they were single to the same person. It's one or the other.
I actually had that with one of my kids. One of my kids decided while they were in college that they were going to, not be dependent anymore. And we still had them as a
Oh,
dependent. We
right.
just never talked about it. And that came back. So we had to
Yep.
redo that. Here's a question from our YouTube channel from Geraldo. I'm in my first year of owning rental property and have accrued losses, of course, because you're working on it. If
Mhm.
my gross income's over $150,000, what are some strategies to reduce my modified adjusted gross income to fall between 100 and 150 so I can use the rental losses?
Well, it's easier if you've got a Schedule C, because then you'll be able to maybe get that income under. So I just was doing a tax return yesterday. Their W-2 income was 152,000. I'm sort of screwed because I need 150. It's completely cut off. 125. I'm halfway to cut off, and so I'm trying to figure out how can I get under the 150 so we can get a little bit of a break. If I've got a
With
Schedule
wait,
C,
with 152 of W2 income.
right? So my AGI right
Yeah.
off the bat is already 152.
Yeah, you're done.
So a Schedule C with a loss, legitimate loss, is going to bring me down, maybe under that.
Okay.
But I'm gonna have to look at those kinds of things. I mean, really, Schedule C is probably my best bet, or farm income for those that run in the farm.
Right.
You've got to be able to generate a loss, because especially with the W-2 income, it's not, you can't move the dial, can't move the needle.
One of my farming clients told me, Bob, she said, what did the farmer do when he won the $1 million lottery? Do you know this one?
No.
Farmed it till it was gone.
That makes sense.
Which is funny, but which by the way, it is hard to run a farm. It's very difficult to run a farm, but every farmer I worked with had just tons of dollar bills hanging around,
Yes, they do.
I think there was a lot of money in the basement.
Yeah. In the soil, so to speak.
Yes. Yeah. Karen asked a question that I was thinking as well, Bob, which is, you see these people that they're evaluating whether to file jointly or separate. You just brought that up, married filing separate. My understanding is married filing separate is largely 99% of the time a waste of time, and you're not going to do that well. But when does it make sense for you to actually do it both ways and see which one's going to be better?
So if both spouses are making a lot of income, it makes sense to sort of see which one's going to work out better, because sometimes married separate actually slightly yields a better result. Mostly not. It's usually pretty punitive. The main time that I'm looking at married filing separate, I've got a spouse that might be doing something beyond the law, and we don't want the other spouse to take a hit for their unreported drug money or whatever might be going on. And I've had a couple situations where
we might just want one of us in orange.
Exactly. So somebody can visit. Right. So sometimes if you think there's some stuff going on fishy with your spouse, you might want to file separate just to protect yourself from any liability, because if you file joint, you're on the hook for your spouse's tax bill, even if they don't pay it.
Yeah. Message from Steve Stewart hanging over. Hanging out.
Hey, Steve Stewart.
Says hi. Steve says hi. Hey, Steve, glad you're here. Steve gets to edit our nonsense. So yeah,
there you go.
Had we known Steve was here live, I would have stuttered my butt off. I would have just totally
made life hard for him.
just get my money's worth, Bob. That's all we're trying to do.
That's right. Well, he'll charge you extra, but you get to write it off.
That's perfect. Which is the same as free. I love that.
Exactly.
Did you see that? Did you see that Schitt's Creek episode?
No, I have not watched that show. Everybody's been telling me recently that, like, why are you not watching this show? So,
I
haven't seen it. Tell me what.
Yeah, there's a whole episode where David is helping out at a local like a dress barn kind of store, and this poor woman that owns it, he's trying to really make it upscale and fashionable and whatever, and she comes in one day and they have tons of inventory, and she's like, "Where'd you get all this?" He's like, "Oh, I ordered it. We got to have all the spring things." And she's like, "How are we going to afford it?" He's like, "Oh, we'll just write it off."
Yeah.
Because that just makes it free. Yes.
Yeah. Write-offs are great, but it's still money out of pocket.
Well, and that's the funniest thing about that episode, because David does not understand that. And she ends up going under, because David's like, "Oh, we just write it off." I mean, he's got food being delivered, like everything. Yeah.
Sure. It's all a write-off. It's all a write-off.
Super fun. Let me think, because I thought I had another question based on the married filing separate. No, I don't think I do. All right. Anybody else have anything? I think we're good. Well, guys, you'll hear Bob on the show in what day? Bob will be on the April 5th. Yeah, so we're going to run it not that long before tax day. So in a couple of
Almost
weeks.
here. Almost here. Now, see, California got a break. Our deadline is October 16th, because we had a little rain and we got wet. We all cried, so they gave us an extra several months.
Yeah, but I was going to say, is that the upside to Mother Nature? I didn't know there was an upside to that whole thing. Holy cow!
We get to make late payments.
Just watching all of that is some of those people. I feel so bad for them.
Yeah.
Oh my goodness. I was talking to a guy who was at the economy conference, Dinah Merriam's conference last week. And one guy lives in an area, near, like high forest fire, a threat. And his homeowner's bill is just through the roof because for his entire county, they haven't segregated. They haven't broken any laws. Just if you live in this county, it's going to be, so he lives in just an insane, I don't even remember how much money he told me his homeowners was, but I choked on my beer. It was,
it's rough.
Not good.
It's rough.
Yeah. Well, and I'd imagine for some of these people in flooding areas, it's gotta be horrible too. I can't imagine.
Yeah.
Don't get me wrong. I'm not crying for the insurance companies, but I just got to imagine they're going to sock it to them.
Oh yeah, for sure. Between the floods and the earthquakes and, the end of the world, insurance is expensive here.
What happens if next month we have locusts? What do you do then, Bob?
Well, you can write off the pesticides if you have a business.
All right, everybody. He's Bob. I'm Joe.